As the number of outbreaks increases, so too does the information and clarity on this pandemic. Here to tell us how traders can play this market, we have Matt Cabangon of AAA Equities. Morning, Matt. Just opening very quickly here, we are slumping below 7,400 yet again, down 0.4%, 7,375. Now tell us, in these kind of markets which are very sentiment-driven, how can traders play the game?
Sure. Active traders, or tactical traders as I like to call them, really, in this kind of market, don't change the playbook.
Okay.
It's all about buying low, and when supports are broken technically, then it's time to cut your losses. Okay. Now, this isn't really sort of a sustainable market to be doing this in.
All right.
I advise clients to be very choosy with which issues to buy, because right now, it's just a lot of gloom and doom across the board.
Okay, so not necessarily a lot of fun, but nevertheless, you did mention to stay choosy. Should we be picking up the stocks that have been heavily sold off, or should we actually be looking at more diversified, more defensive stocks at the moment?
Right. Well, right now, I don't think investors should be trying to catch the knife on stocks that have fallen significantly. There are some index names that have fallen only slightly and have generally held up quite well.
Okay.
And I think those stocks that show resilience are great picks to stay resilient moving forward. So I would be positioning myself in those stocks versus the ones that have slid 10, 15%.
Why is that? Do you still feel that they might be going lower and we haven't really bottomed out yet?
Well, I'm not one to sort of pick bottoms where we are right now. Right now, we're seeing uncertainty everywhere. There's uncertainty in spades. On sort of a major macro level, there's obviously the coronavirus. But even as we sort of dig deeper into sector-specific risks, there's uncertainty everywhere. So right now we have the POGO crackdown sort of coming back up again with human trafficking even involved. We have utilities such as water and now even Meralco, both with major questions, and of course the ABS issue. So we're seeing sort of broadly uncertainties everywhere. So I like to position myself in places where those don't exist.
Are these broad-based risks that will spread over the index? I mean, how do you play the index at this point, and can you even play it, or do you stick to those specific stock picks as you mentioned?
Well, right now the index is sitting on a pretty strong support. So I would be adding a little here, but granted, sentiment has been leaning towards just moving lower. Like yesterday we saw the market close higher at the close. That's typically not a good sign. I like to see the market trade higher throughout the trading day. So right now, to me, the bias is certainly lower for the index. Okay,
so you still see this going lower, but as you mentioned, you don't really look at the support levels per se. You mentioned some sectors that you're bullish over. Let's talk about banking space, especially after, well, one piece of good news that we had this week was that possible upgrade to an A in the near future, and Fitch actually upgrading our outlook to positive. Will this bode well for the banks? Is it an immediate sort of effect, or will we be seeing that in the earnings coming out?
Absolutely. The banking sector is sort of the anchor of our entire economy. With a potential A rating in the cards, they're certainly a beneficiary of that upgrade. But looking at earnings of BPI and Unibank, two of the big banks that have reported Q4 earnings, they were spectacular. So that tells us that the BSP's easing measures from last year have continued to benefit the industry. And again, in a world of uncertainty, the BSP being accommodative is not one of them. It's one of the certainties, and it's one of the reasons why I prefer the banking sector.
Because their stance is actually clear. But don't you feel that that might impinge on the margins if the BSP keeps cutting lower? And, you know, some analysts have said that the reason why banks did rally last year was a lot of trading gains and also maybe, a lag effect of having pretty high interest rates the year prior. So, how would this all bode well for the banks? Won't it be depressing the margins too much?
Well, just using the BPI earnings as a sort of baseline, we saw net interest margins expand. We saw loan books expand as well. So I wouldn't be betting on those margins collapsing anytime soon. It seems to be like that the inertia is in favor of banking strength.
What's your take on the BSP? I mean, still looking at cutting rates, but also some investors flagging risks of inflation. I mean, we just had, Taal now lowered to level 2, so that's a good thing. But you've also got the ASF still on the table, but at the same time, oil paring back down, but the nCoV. So how does this all fit into, your inflation outlook and whether the BSP still has more room to cut in the future?
Right. I mean, right now, the BSP, I think the risks are, I absolutely agree with you. I think the risks are now towards hiking the rates, given that we were coming from such a low base of inflation last year. So it's very likely that we'll see inflation tick up this year. However, we're in an entirely different regime now. The triple R is in a different range altogether. So even if the BSP were to were to hike even just a little bit, I don't see it as very material considering how much easing they've already done.
Okay, you've got Metro Bank as your pick here. Tell us, why was this? I mean, I was taking a look at this stock, and it was, heavily sold off, and still investors are pretty iffy about this. What's your outlook on this and the earnings, and how they would compare to the rest of the ones that have already reported?
I think Metro Bank will report just in line with the rest of the sector.
Okay.
Well, not quite with Union Bank. Union Bank reported 300% net income, but that was all trading gains. But Metro Bank, compared to at least BPI, should be in line. The reason why I prefer them is because of valuation measures. Right now, BPI and BDO are trading above 1.5 times price to book value.
Okay.
Metro Bank is not quite there yet. It's trading below book value. So I think before those other banks take the next step higher, Metro Bank has to catch up before the banking industry really starts seeing a lift. So I think this is a low-risk play on the banking industry.
Okay, interesting point there. Now let's move on to properties, which one stood out yesterday, and that was Mega World. And one analyst had said that was because of the Pogo issue, and you had flagged that earlier on in the broadcast. But tell us, why is this stock still being so severely battered, especially after they've said so many things that they're not materially affected by the Pogo issue, and there's still a lot of diversification going on in this stock.
I mean, regardless of what management says, I think the market believes otherwise, and for good reason. Mega World is one of the most exposed developers to the Pogo sector.
All right.
And the Pogo sector, aside from seeing pressure from the administration, is suffering hugely from the coronavirus.
Right.
Clients and employees I assume, are stuck in China or stuck here. So it's not a good exposure on several levels, and that's the reason why we're seeing Mega World being sold off quite hard.
Is this a temporary sell-off based on sentiment, or is there a fundamental repricing of this stock because of all of these issues?
That's a great question. I think right now, because we've seen these threats against the Pogo sector by the administration for however many times now, I see it more as a sentimental move than as an actual derating of the stock.
Okay, so let's talk about Ayala Land, which on the other has also had its own share of issues, but it's severely sold off on that UP Techno Hub issue with President Duterte, but now tapping into REITs. Tell us, what's your sentiment on this stock, especially it's on the radar of the president, it's on the regulatory risk agenda as well, but has a lot of other prospects going forward.
Yeah, Ayala Land should be reporting Q4 earnings very soon, and as a major developer, everyone will be looking at that to sort of gauge where the sector is headed. Unfortunately,
what are you expecting?
Well, I'm expecting no surprises there, but that's because we haven't seen. I need to remind the viewers at home that Q4 doesn't include the effects of Taal, the effects of nCoV. So these are brand new major risks that won't be reflected in Q4 earnings.
Okay.
So I think investors will be taking positive news out of Q4 with a grain of salt and probably discounting that moving forward. But overall, I think there's a very constructive view on Ayala Land. Their new REIT is a very exciting venture. It contains 3 of their big Makati properties. Now, granted, it's not a blockbuster portfolio of real estate projects by any means. I think it's a great sort of practice for Ayala Land to sort of see and feel what the REIT market will get them with their big ticket projects.
But you mentioned already the Q4 earnings. We actually, the earnings in the first quarter, at least first 2 quarters last year, they had mentioned were lower than they had expected, given the fact that there was a budget delay and some of the projects were not, were they able to catch up? And will we be seeing that? And, just as you already mentioned, this does not take into consideration the risks that we are seeing in this quarter. What is it going to be looking like for the property space in the first half of the year?
Well, not just for Ayala Land, but for across the property space, no one was able to catch up because of the delayed budget.
Delay.
But because that's a sector-wide issue, there's really no way to play it on an individual stock basis. But now that risk is gone, right? The budget has already been passed for this year. It should be smooth sailing. And now we're faced with an entirely different risk in nCoV. So I'm a little underweight on the property sector as a whole.
Gotcha.
I think the risks are pointing to the downside for this sector.
Okay, and do you feel that that's nCoV related, or that the nCoV risk could spill over the fact that they cannot carry on specific projects?
Well, nCoV related in such that hotels are taking a beating.
Okay, still consumption driven.
Absolutely.
Okay.
So tourism obviously is a big industry that will suffer. But also, if this plays out long enough, we can start seeing malls start taking a hit. And that's when our really big property developers will start feeling it in their bottom line.
Okay, but just to point out for Ayala Land, they have been sold off. Have they reached the bottom for that issue of the Techno Hub thing?
Well, I think the Techno Hub thing has basically been resolved at this point.
Okay.
It's a relatively minor part of their top line, so market shouldn't read much into it. But given the ability of headlines from the administration swinging markets, it's hard to say whether something is really over.
Okay, but as you mentioned, a minor part of their huge portfolio. Let's talk about some nCoV-related stocks here that have been, on the radar of a lot of analysts. Let's kick off with IMI. So this one, apart from the, manufacturing being halted, they were taken out of the MSCI index for small caps. Are you really worried about a significant dent in the manufacturing space? Not just IMI, but, maybe SFA or others that have industries in China?
I consider myself a very bullish person, but on IMI, I am a very big bear.
Gotcha.
We can management was guessing that by 2020, at least Q1, we would see a recovery. However, that's not what we're seeing globally. Vietnam is one of the biggest exporters of electronic goods to China. They reported a 20% drop in January of exports. And if that at all holds true for IMI, it's going to be a very ugly start of the year for them.
We were talking with other people, and they were saying that there might be a bright spot in the Philippines because of this nCoV scare, that some manufacturing hubs or that were in China might be moving here. Do you feel that that could prop up the sector?
I'm not sure I buy into that narrative, considering that nCoV is, although not as bad here as it is in China, is certainly present here. And I don't think that if I were a multinational company, I would be looking at really diversifying away from nCoV versus something so peripheral.
Okay, and finally, just to close, JFC, they actually had mentioned they're still waiting on more details on it and whether that will hit their bottom line. Will it be hitting their bottom line? How big of a dent will that be, especially they have 7% of their stores in China?
It's going to be a tough year for JFC. They're projecting that Smashburger will turn around by year-end 2020.
Right.
I think markets are unconvinced by this. So while I don't think it's a sell, it certainly isn't a buy right now. So JFC to me is a hold.
Okay, JFC, a hold and a lot of caution on a lot of the other stocks, but nevertheless, still bullish on Metrobank and the banking space. Thank you so much, Matt Cabangon.